In this next section, we're going to take a look at the smart money cycle. Now, we know that as retail traders that our ultimate objective is to trade in line with smart money. So we took a look at the intraday trend and we saw how it moves in three stages or legs to the high or low, and it has periods of liquidation which causes a retracement or counter-directional move against the trend. Now, we're going to look at not only the intraday trend, but we're going to look at the longer term daily trend. And by having a understanding as to how and where smart money tend to move the market over the period of a few days, will give you a good understanding as how to trade in line with the smart money trend, and also to identify the high probability direction for the intraday trend. Okay, so in a previous section of this course, you learnt that price moves in trends, and by understanding cycles, it can help you to determine who is winning the overall battle. Now, in terms of what you have learnt and what you now understand as the role of the institutions within Forex, you should now know that in terms of the battle, smart money are always winning. Okay, so it's commonly taught to retail traders that in a bull trend, the buyers are winning over the sellers, or the bulls are winning over the bears, and vice versa in a downtrend, that the sellers are winning over the buyers, or the bears are winning over the bulls. Now, we know that smart money are always winning the battle, regardless of what retail traders are doing. Okay, so to trade successfully, you must be able to identify the trend and trade in that direction. So traditionally, we'd be looking towards patterns of higher highs and higher lows, or lower lows and lower highs, to get an idea as to the overall direction of a market's trend. We would also refer to trading indicators such as oscillators like the RSI, stochastics, and any of the other momentum measuring indicators that will give us a clue as to the momentum of the market and the probable direction of the trend. Now, we know that smart money are responsible for moving the market. We understand now that they accumulate a position, they then manipulate the price action in an area of deep liquidity, and this is usually in the opposite direction to their intended direction for the trend. And then once this manipulation is over, the trend will unfold. So in terms of being able to identify the trend, we have to first identify the process behind smart money, and we also need to understand how they tend to move a trend. And again, we briefly looked at this in terms of the intraday trend, where we saw that it moves in three stages or three legs to the high or the low. So we know that trends are created by large institutions, and we know that smart money will always liquidate their positions throughout this trend. So we're going to look at how we work out, or with a high degree of probability, trade in line with the intraday trend by having an understanding on how smart money move the longer term daily trend. So what is the smart money cycle? Now, smart money move the FX market in two distinct cycles. We have the intraday cycle, which we had a look at in our last section, and also we have the longer term weekly cycle. Now, once these cycles are understood and identified, retail traders can use these cycles as a guide or roadmap as to which side of the market they should be trading. Okay, so once we have a good understanding as to the intraday and the weekly cycles that smart money tend to unfold, we have a good understanding as to which side of the market they should be trading. And for most traders, that is their biggest problem, because as we know, 95% of traders or retail traders are on the wrong side of the FX market. So this highlights the fact that understanding what a trend is and how to identify one is not enough to survive in the FX market without understanding the true cause behind the trend, which is smart money. So the smart money cycles tend to move in 3 distinct stages. The smaller intraday cycle is seen as 3 legs of prices rising or falling throughout the trading day. And we saw examples of this in our last section, that once smart money had accumulated a position and then manipulated the market and absorbed retail orders, that a 3-legged or 3-stage trend would unfold to the high or the low of the day. And as we saw, this trend is very often seen prior to the intraday reversal and accumulation of the market at the end of the US trading session, and we refer to this as the New York reversal. Now, the intraday cycle can be clearly seen on the 15-minute chart, and the examples in our last section were all on the 15-minute chart, and it is the chart that we will be looking for our manipulation levels, our manipulation at these levels, and also the market trend. So the intraday cycle and the analysis and trading of the smart money strategy will be executed on the 15-minute chart. In regards to the weekly cycle, the smart money weekly cycle is the most important. Okay, so out of the 2 cycles, the weekly and the intraday, the weekly cycle is definitely the most important. And again, the weekly cycle will be seen as 3 distinct phases or legs of prices rising or falling over the course of 2 to 3 days. So the weekly cycle is executed in exactly the same way as the intraday cycle. The only difference being is the time span. Okay, so the intraday cycle, the 3 stages or legs will unfold over the course of a day. With the weekly cycle, we're going to be expecting 3 distinct phases of legs of prices rising or falling, but over the course of 2 to 3 days. Now, the average range on the cycle, depending on the pair and also the time of year and market conditions, and I've said this before, it ranges between 150 to 350 pips. And again, this is down to you and knowing the behavior and characteristics of the pairs in which you choose to trade. Now, in terms of the time frame that we use to identify the weekly cycle, the weekly cycle can definitely be seen most clearly on the 1-hour chart. Okay, so we're going to be looking at the 1-hour chart to identify the longer term weekly cycle, and then we're going to be using the 15-minute chart to identify manipulation points in line with the direction of the weekly trend, and then we'll be executing trades on the intraday trend in line with the smart money cycle. Now, one phase or leg within the weekly cycle will be measured from one day's Asian session to the following day's Asian session. Okay, so in effect, one phase or leg within the weekly cycle is made up from one three-legged intraday cycle. Okay, so the intraday cycles make up the weekly cycle, but one complete intraday cycle, which is 3 levels of rise or fall to the day's high or low, will make up one weekly leg. And this weekly leg will be measured from one day's Asian session to the following day's Asian session. And depending on the pair, the average leg of a weekly cycle will vary. Okay, so when we're looking at the intraday trend within each of the pairs, we know that depending on the volatility and the type of pair it is, it's going to have a different range compared to others. So in terms of the leg for a weekly cycle, the complete leg from one Asian session to the other, depending on the pair, this is going to vary. Now, once the 3 levels of rise and fall are complete on the weekly cycle, smart money will move prices in one of 2 ways. So once we have seen 3 levels of rise or 3 levels of fall over the course of 2 to 3 days, generally one of 2 things will happen. First thing is that smart money will begin to accumulate positions and reverse the market and begin a new trend opposite to the prior 2 to 3 day cycle. Okay, so you will see 3 levels of rise or fall, and then smart money will begin to accumulate positions, and this accumulation is referred to as level 3 accumulation, which we will go into later on in this section. And then they will reverse the trend opposite to the prior 2 to 3 day cycle. So in this example, we're looking at the Australian dollar versus the New Zealand dollar, and we're looking at the 60-minute time frame for the weekly cycle. And on day 1, we have a move to the upside, and we have a period of accumulation leading into the next day. We then have a second extreme move to the upside, and then on day 3, during the Asian range, we have our third and final move to the upside. So once we've seen 3 cycles of rise or fall over the course of 2 to 3 days, we then go into what's called level 3 accumulation. And the only difference between this accumulation and others is that level 3 accumulation will take place over a longer or extended period. So level 3 accumulation is where smart money are building their large position for the weekly cycle. Okay, so we see during the day-to-day sessions, we have the smaller periods of accumulation leading into the following day. But for the weekly cycle, we're going to see the same thing, but we're going to see an extended period of accumulation over the course of 2 to 3 days. So we have 3 levels of rise, and then we have this long period of accumulation, and we can see that this extends over 1, 2, 3 days. Now, in terms of how the manipulation works, the process is exactly the same, but on a larger scale. So we now have a period of accumulation. So we're going to expect to see manipulation in the form of a move to the opposite direction of their intended move of the trend, and then we're going to see the trend unfold. So After this extended period of accumulation, which has lasted 3 days, we see the market moves to the upside, and here we have a stop hunt in the form of an M. Okay, and the M formation stop hunt is a form of manipulation, and we're going to take a look at the intricacies of the M and also the W stop hunt. But for now, I'm just going to concentrate on the weekly process, and we can see that we've had the stop hunt, which is a move opposite to their intended direction. This again is going to cause the support and resistance traders and also the breakout traders to buy into the market once this level of resistance has been broken, allowing smart money to sell into this buying pressure and ultimately push the market to the downside. Okay, so we have the exact same process that we have on a larger scale. So we have 3 levels of rise, we have an extended period of accumulation, we have a move against their intended direction, which is the stop hunt, which induces the retail traders into the wrong side of the market, and then we can see a reversal of the trend. Okay, so again, this is one of the 2 ways that smart money will begin to move the market after we have seen 3 levels of rise or fall. Now, the second way in which smart money will move the market after seeing 3 levels of rise or fall during the period of the weekly cycle is that they will accumulate positions and then perform a longer term stop run and then reverse and continue the prior trend. Okay, so all that simply means is if smart money have sold the market over a 2 to 3 day period, they will then accumulate more positions, they will then move opposite to the intended direction, which would be up in this case, and then they will continue the downtrend for another 2 to 3 days. So in this example, we're looking at the sterling against the dollar, and we're on the 60-minute chart to clearly see the weekly cycle, and we can see that on day 1 we have a move to the downside. We then have our period of accumulation. We then on day 2 have our second move to the downside, and then we go into another period of accumulation, and then on day 3 we have our third and final move to the downside. So this 3 levels of fall completes our weekly cycle, and then just like with the intraday cycles where we see 3 levels of fall and a period of accumulation, we have 3 days of fall and we go into our level 3 period of accumulation. And the accumulation in this example lasts for a period of 2 days, and once the accumulation has taken place and smart money have built their orders for the next cycle, we see this manipulation take place, which is a move opposite to their intended direction. This again induces buyers into the market, because as the market begins to rise here, most retail traders are going to believe that the market is in a bull trend, and the influx of buying allows smart money to sell into this buying pressure, absorb the orders, and then move to the next phase of the trend. And in this case, after the period of manipulation, they move the market back down towards the downside. So they have continued the prior trend, And we see again a move to the downside on day one, period of accumulation. We then get our second move to the downside, accumulation, and then our third move to the downside. So in terms of the second way that smart money will move the market after 3 levels of rise or fall on the weekly cycle, we're either going to see a reversal of the trend after a period of accumulation and manipulation, or we're going to see, as in this case, a continuation of the prior trend following level 3 accumulation and manipulation. So you now know that smart money moved the market trend in 3 distinct phases. So if we can determine and identify which phase of the cycle we are in on the longer term weekly trend, it will allow us to trade the market's shorter term intraday trend in line with smart money. So identifying where a currency pair is within the long and short term smart money cycle is essential. Okay, so being able to identify where the weekly trend is and then being able to trade in line with that weekly trend is an essential part of our strategy. Now, the levels can be identified visually on the 1 hour chart, and the phases are separated by the accumulation periods within the price action. And we saw in the previous example that after each of the legs that take place during the weekly cycle, that they were separated by a period of accumulation leading into the following day. So these highly visible consolidation / accumulation areas are typically artificial support and resistance zones created by smart money. Okay, so these levels of accumulation, as we have discussed before, are artificial support and resistance zones. And what they do is that they allow traders the opportunity to place orders either side of the zone and build deep liquidity. And we've looked at several examples of this. Now, these areas are most likely to be areas of previous support and resistance. And when we get to our section on identifying manipulation levels, we're going to take a look at how we identify manipulation levels and how a current day's manipulation level will generally line up with previous support and resistance. So we know by now that once the right time and volume is reached, the stops of retail traders will very often be triggered by smart money before the next phase of the trend is started. And as we saw on the intraday trend, this will occur during the Japanese session or other levels of support and resistance. And in terms of the weekly cycle, the stops of the retail traders will be triggered by smart money after level 3 accumulation. So if we see prices rise in the market over the course of 2 to 3 days on the 1 hour chart, we would expect a third level of rise on the following day to complete the smart money cycle. Okay, and that's just common sense, and we saw this in our example with the intraday trend. On the intraday trend, when we had looked at the trend and the separation in terms of the liquidation, and we saw 2 levels of rise, especially leading into the US session, we would be looking for a third level of rise. Now, the same is true for the weekly cycle. If we see 2 levels of rise or fall, we would be expecting a third level. And this highlights the importance of being able to interpret exactly where you are in the cycle. Okay, so if we saw 2 levels of rise or fall, the following day we would be looking to take a long position intraday. We would also look to identify areas where the manipulation and absorption of retail sell orders may likely take place. So in this example, we're looking at the US dollar versus the Canadian dollar, and we're on the 60-minute chart looking at the weekly cycle. So on day one, we have a clear move to the upside. We then can see the New York reversal, and then we can see a period of accumulation going into day two. So from here, we would be expecting another move to the upside on day two. And we see this move, an aggressive move up, leading into our third day. Now, being able to interpret the cycle is what allows you to trade intraday in line with the smart money trend. On day three, we're going to be expecting a third move to the upside following the smart money cycle. So if smart money are planning to push the market up, because we don't know this, but in terms of the cycle, and we know that they tend to move the cycle in 2 to 3 day moves, if they plan to move the trend up for one more leg, we know that after the accumulation period throughout the Japanese session, they're going to induce traders into the wrong direction. Okay, so if on day three, they're going to push the market up for the third and final leg in the weekly cycle, after the Japanese session and the start of the European session, we're going to be looking for levels of manipulation to absorb sell orders. Okay, so in terms of the Japanese session, we'll be looking for levels of support and levels of support at other levels where once they're broken, retail traders will believe that the market is going to move to the downside. Smart money will then absorb these sell orders and push the market up for the third and final leg. So on day three, as the Japanese session closes and we can see this period of accumulation, we'll be calling up our 15-minute chart. And as you can see here, we have day one, day two, and we're now here on day three. So what are we going to do? We're going to look for levels of support or areas where a build-up of orders may exist. So the first thing we're going to do is we're going to mark out the lows or the support of the Japanese session. Okay, because we now know that if price breaks this level, we're going to have an influx of sellers into the market where smart money can buy into this pressure. Also, those people who may have bought at the top end of the range will generally have their stop losses below this support level, and if you've bought, your stop loss will be a sell. So we know with a high degree of probability that there are going to be a build-up of retail sell orders either at the Japanese support or lower levels. Okay, so for example, we have another level of support here, and we also have another level of support here, which is the previous day's Japanese session lows. Okay, so we've identified 3 areas where sell orders, retail sell orders, may build up or induce traders into the wrong side of the market, and smart money can buy into this selling pressure and move the third and final part of the weekly trend to the upside. So we'll scroll over, and as we scroll over, we can see that price action has moved to the downside, breaking this level of support. So the selling pressure from the retail traders will begin, allowing smart money to buy into this selling pressure and ultimately move the market up for the third and final day of the cycle. Okay, so we have two levels of rise that we had identified on our weekly cycle, and on the current day or the third day of the cycle, we would be expecting smart money to manipulate retail traders into the wrong side of the market, which, as we know, because we're expecting a third level of rise, will be to the downside. And once we have identified our areas of support or resistance where selling pressure from retail traders may come in, once we have recognized manipulation, which we can see clearly here, we can then buy into the market and trade in line with the smart money weekly and intraday trend. Now, in a downtrend, it will work exactly the same, but we'll be simply looking for areas where buying pressure from retail traders will be induced into the market, allowing for smart money to sell into this buying pressure and continue the third and final move down of the weekly cycle. So in this example, we're looking at cable, the sterling against the dollar, and we can see that we have a move to the downside on day one, accumulation. We then have another move to the downside on day two. So just from a directional perspective, we're going to expect a third move to the downside. Now, is it guaranteed that this third move to the downside will happen? No. But in terms of probability and through our understanding of how smart money move the intraday and also the weekly trend, we're going to go with the high probability outcome that a third move down is on the way. So if that's the case, on day three, once we've identified the two moves to the downside for the weekly cycle, on the 15-minute intraday chart on day three, once the Japanese session is over, we're going to be expecting manipulation to the upside, because we know that they're going to induce traders into the wrong side of the market, absorb their orders, and then finally finish the weekly cycle with a move to the downside. So on this day, as the Japanese session comes to an end, we'll be looking for levels of resistance where breakout traders and support and resistance traders will come into the market and buy once a level has been penetrated. So the high of the Japanese session will be our first level of accumulation, and then we have a higher level of resistance, which is the previous day's Japanese high, and then we also have another level of resistance just above this level. So in and around one of these three zones, we'll be looking for manipulation to take place, and once that manipulation takes place, we can then sell into the market in line with the smart money weekly and intraday cycle and profit from a move to the downside. So if I scroll the market on, we can see smart money moved the price aggressively through the Japanese high, through the high of the previous day's Japanese session, and then finally we aligned with a previous level of resistance. Smart money then absorbed the retail buy orders that come into the market, because at this point many retail traders will believe that the trend for the day is going to be up. They've been induced into the wrong side of the market, and then we can see this aggressive bar to the downside, and then ultimately the third and final part of the trend, which completes both the intraday and also the weekly cycle. And previously I alluded to the fact that many support and resistance levels where manipulation can and will take place will align with previous levels of support or resistance, and this is a classic case of resistance being set 2 days ago and smart money being aware that this level has been identified and marked off on many retail traders' charts, and then it allows them to come in, absorb these orders, absorb the breakout orders, and push the market down and complete the trend. So this highlights just how important it is to be able to interpret and understand the smart money cycle. By understanding where we are within the weekly cycle, it will allow us to trade in line with the smart money trend. So we know the smart money weekly cycle will generally unfold in 3 stages over the course of 2 to 3 days, and that by understanding and identifying where you are in the smart money trend, this can allow you to catch part of a trend or the entire cycle. Okay, so the 3 stages of the smart money trend is stage 1, stage 2, stage 3, and then back to stage 1. And we're going to have a look at the characteristics of each of the phases, and this will allow you to clearly identify as to which phase or stage of the weekly cycle you are in.